Right now, as we speak, there are 528 million ounces worth of silver contracts set to deliver in March on the COMEX exchange. The problem? There are only 113 million ounces of deliverable silver actually sitting in COMEX warehouses. That's not a typo. Contract holders are demanding nearly 5 times more silver than the exchange has available to deliver. And if you think that sounds like a recipe for disaster, you're absolutely right. Because what's happening in the silver market right now isn't just another price spike or some temporary squeeze. This could fundamentally break the entire system of how precious metals are traded globally. Let me put this in perspective. Back in October 2025, just 4 months ago, COMEX had 167 million ounces of registered silver available for delivery. Today, that number has collapsed to 103 million ounces. We're talking about an inventory drain of 785,000 ounces per day, every single day. At this rate, by the time March delivery comes around, the mathematics simply don't work. You cannot deliver what you don't have, and right now, the COMEX is facing a potential reckoning that could reshape precious metals markets for decades to come. Now, before we dive deeper into what this means and where this is all heading, let's talk about what's been happening with silver prices, because the volatility has been absolutely insane. As of today, February 8th, 2026, silver is trading at around $78.52 per ounce. That might sound high to some of you, and historically it is, but here's the wild part. Just 10 days ago, on January 29th, silver hit an all-time record of $121 per ounce. Yes, $121. And then it crashed 40% in a matter of days. Think about that. The most volatile cryptocurrency looks tame compared to what silver just did. So what caused this insane price action? Well, a big part of it was the CME, the exchange operator, repeatedly jacking up margin requirements for silver futures contracts. They've raised margins 6 times in this cycle, with the latest increase pushing requirements to 18%. Now, for those of you who don't trade futures, let me explain what this means in simple terms. When you buy a futures contract, you don't pay the full price up front. You put down a percentage as margin, kind of like a down payment. But when the exchange suddenly requires you to put up more money, and you're already leveraged to the hilt, you have 2 choices. Either come up with more cash immediately, or sell your position. When this happens to thousands of traders at once, you get forced liquidation, which means massive selling pressure, which means prices crash. That's exactly what happened when silver went from $121 to current levels. But here's the thing, and this is absolutely critical to understand. The price crash doesn't change the fundamental problem. It doesn't magically create more physical silver. It doesn't make the March delivery situation any less precarious. If anything, it might make things worse, because now you have contract holders who survived the margin calls, who held on through the volatility, and they're probably even more determined to take physical delivery. Let's talk about what makes this situation different from past squeezes or supply crunches. We're now in the 5th consecutive year of structural supply deficits in silver. This isn't a short-term blip. Industrial demand has been consistently outpacing mine supply for half a decade, and the demand drivers are only getting stronger. Solar panel production alone now accounts for 29% of industrial silver demand, up from just 11% in 2014. Every time someone installs solar panels on their roof or a utility builds a solar farm, that's silver being consumed, permanently removed from available supply. A single 500 megawatt solar array requires roughly 300 metric tons of silver. And we're not just talking about solar. AI infrastructure build-out has been massive. Global IT power capacity has increased 53 times since 2000, from less than 1 gigawatt to nearly 50 gigawatts in 2025. All those data centers, all those servers, all that computing power requires silver. For connections, for thermal management, for reliability. Then you've got electric vehicles ramping up production, and there's new battery technology coming online. Stanford researchers just announced a breakthrough in solid-state batteries using 3-nanometer silver coatings that provide 5 times the damage resistance. If that technology scales, we're talking about another massive source of silver demand that didn't even exist a few years ago. So demand is surging from multiple directions simultaneously. Now let's talk about supply, because this is where things get really interesting. On January 1st, 2026, China implemented export restrictions on silver. China is a massive player in refined silver production, and they've essentially ring-fenced a huge portion of their output for domestic use only. This removed a significant chunk of supply from global markets, right as we're hitting these structural deficits. The timing couldn't be worse for anyone trying to source physical metal. And here's where the paper versus physical divergence becomes impossible to ignore. While silver is trading at $78 on the COMEX, physical premiums in markets like Tokyo and Dubai have hit 80% above spot price. Let me say that again. In some markets, people are paying $140 or more per ounce for physical silver, while the paper price says $78. That's not a normal market functioning properly. That's a market screaming that there's a fundamental disconnect between what futures contracts say silver is worth and what people will actually pay to get their hands on real metal. Now, let me explain the difference between registered and eligible inventory, because this is crucial to understanding why the COMEX might be in serious trouble. When you hear that COMEX has a certain amount of silver in its warehouses, that number includes two categories. Registered inventory is silver that's been designated as available for delivery against futures contracts. It's sitting there, ready to go, with all the proper documentation, and it can be delivered to satisfy contract obligations. Eligible inventory, on the other hand, is silver that's stored in COMEX warehouses, but isn't available for delivery unless the owner decides to convert it to registered status. Think of it like this. Imagine you run a car rental company, and you advertise that you have 500 cars. But only 100 of those cars are actually in your rental fleet. The other 400 are parked in your lot, sure, but they belong to other people who are just using your parking facility. You can't rent out those 400 cars unless the owners agree to let you. That's the difference between registered and eligible. And right now, eligible silver owners are not converting their metal to registered status, even with prices at these levels. Why? Probably because they think prices are going higher, or they need that physical metal for industrial use, or they simply don't trust that they'll be able to get it back if they let the COMEX use it for deliveries. So when we talk about the March delivery crunch, we're really talking about that 113 million ounces of registered inventory trying to satisfy 528 million ounces worth of contracts. The math doesn't work unless something changes dramatically. What could happen? Well, let's walk through three scenarios. The first is that COMEX survives this relatively intact. How would that work? They'd need several things to happen simultaneously. First, a lot of contract holders would need to roll their positions forward to future months instead of taking delivery. This is actually pretty common in futures markets. Most participants don't want physical delivery anyway. They're just speculating on price movements or hedging other positions. Second, eligible inventory owners would need to convert significant amounts to registered status, either because prices are attractive or because the exchange pressures them to do so. Third, some emergency silver could potentially be sourced from other global inventories or refineries working overtime. And fourth, the price might need to spike again to incentivize more supply and shake out more weak hands will take cash instead of metal. If all these things align, COMEX could muddle through March without a complete breakdown. The second scenario is a partial default or forced cash settlement. This has precedence in commodity markets. Essentially, the exchange would change the rules mid-game and tell contract holders, sorry, we can't deliver the physical metal, so we're settling your contract in cash at the current price. Now, this would be hugely controversial and would likely trigger lawsuits, but exchanges have done this before when facing delivery failures. The immediate impact would be devastating for COMEX's credibility. Why would anyone trust a futures market that can't actually deliver the underlying commodity? You'd see a massive migration toward physical-only markets and away from paper contracts. The price impact would depend on how it's handled, but you'd likely see physical premiums explode even further as people realize paper contracts might not be honored. The third scenario is a full systemic breakdown. This is the nuclear option, where COMEX declares force majeure, which is basically saying an unforeseen circumstance makes it impossible to fulfill contract obligations, and the entire delivery process grinds to a halt. This would be catastrophic not just for silver markets, but for confidence in commodity exchanges generally. If the COMEX can fail on silver deliveries, what about gold? What about copper or platinum? You'd see a crisis of confidence that could spread across multiple markets. The price of physical silver in this scenario could go absolutely parabolic as people panic buy whatever they can find, while paper contract values might actually collapse because, well, what's a contract worth if it can't be enforced? Which scenario is most likely? Honestly, my best guess is we'll see something between scenarios 1 and 2. COMEX will probably survive March, but not without some serious pain and potentially some rule changes that favor the exchange over contract holders. There might be partial cash settlements or incentives offered to roll positions forward. But the key thing to understand is that even if they navigate March successfully, the underlying problem hasn't gone away. So where does this take silver prices? There are several forces at work that suggest the long-term trajectory is up, potentially significantly up. Industrial demand continues to accelerate. We mentioned solar and AI infrastructure, but there's also 5G networks, medical equipment, water purification systems, and dozens of other applications where silver is irreplaceable. Meanwhile, supply is constrained not just by Chinese export restrictions, but by the simple fact that most silver is produced as a byproduct of other mining operations. You can't just open a new silver mine next year and flood the market. It doesn't work that way. The paper versus physical divergence is forcing a reckoning. Industrial users need physical metal, and they're willing to pay premiums to get it. They're bypassing COMEX entirely and going directly to refineries or dealers. This creates upward pressure on the real price, even if futures markets are suppressed by margin requirements or short selling. Then there's institutional positioning. Sprott, one of the largest and most respected precious metals investment firms, just doubled their physical silver trust facility to $2 billion. They're not doing that because they think silver is going down. Smart money is accumulating physical metal while it's still available at anything close to current prices. Retail investor sentiment is also strongly bullish, particularly in communities that have been following this story for years. The Wall Street Silver Movement and similar groups have been buying physical silver consistently, removing it from available supply and storing it outside the banking system. This grassroots accumulation represents millions of ounces that aren't coming back to market anytime soon. And let's talk about the gold-silver ratio for a moment. Historically, this ratio has averaged somewhere between 50-1 and 70-1 over long periods. It got as high as 100-1 just a couple of years ago, which many analysts argued was completely out of whack with historical norms and the relative scarcity of the metals. Now it's compressed to about 75-1. If it normalizes further toward 50-1, and gold stays anywhere near current levels, you're looking at silver potentially in the $90 to $100 range just from ratio normalization, completely independent of supply-demand fundamentals. Reuters recently polled analysts who projected silver averaging $79.50 per ounce in 2026. That's not a ceiling, that's an average, which implies significant volatility in both directions around that level. Some analysts are privately talking about silver potentially testing $150 to $200 if we see an actual delivery failure or if physical shortages become severe enough. I'm not predicting that, but I am saying the range of possible outcomes is extremely wide right now. For anyone holding silver or thinking about positions, the key is understanding what you own. Physical metal that you hold directly or in allocated storage is very different from a futures contract or even an unallocated account at a bank. If this situation deteriorates, that distinction could become enormously important. The premiums we're seeing in physical markets are telling you that there's real scarcity, real difficulty in sourcing metal, regardless of what the paper price says. The March delivery period is going to be absolutely critical. Watch the inventory numbers closely. If registered inventory continues draining at anywhere near the current rate, we'll know by late February whether COMEX has any chance of handling March deliveries normally. Watch for any announcements about rule changes, delivery procedures, or settlement options. Those will be your early warning signs that the exchange is preparing for trouble. Also pay attention to physical premiums. If they start widening even further, that tells you the divergence is getting worse, not better. And watch what industrial users do. If major manufacturers start announcing supply concerns or production delays due to silver availability, that's your confirmation that this isn't just a financial market issue, but a real economy problem. The silver market is at a genuine crossroads. We've got surging industrial demand running headfirst into constrained supply, complicated by a paper market that may not be able to deliver on its promises, and geopolitical factors like Chinese export restrictions adding fuel to the fire. March 2026 could be the month we look back on as when the silver market fundamentally changed, when the paper-physical disconnect became impossible to ignore, and when price discovery moved away from futures exchanges toward physical markets. I don't know exactly how this plays out, and anyone who tells you they know for certain is either lying or delusional. But I do know the math doesn't work right now, and something has to give. Either prices go significantly higher to incentivize supply and discourage delivery demands, or we see settlement failures and rule changes, or both. What I'm certain of is that the next 6 weeks are going to be fascinating to watch. So I want to hear from you. Which scenario do you think is most likely? Does COMEX navigate March successfully? Do we see partial defaults and cash settlements? Or are we headed for a full systemic breakdown? Drop your thoughts in the comments below. And if you found this analysis valuable, hit that like button and subscribe, because we're going to be covering this story closely as it develops. The silver market is entering uncharted territory, and you're going to want to stay informed about what happens next. Thanks for watching, and I'll see you in the next one.